Hi, I'm Darrell Mark. Thanks for joining me on this podcast on igrow.org. Today what I'd like to do is spend a little bit of time talking about government reports. Now, when you're dealing with agricultural commodity markets and all the information that you're getting on a weekly basis or on a daily basis or even an hourly basis, it seems like it's really influenced a lot by the information that's coming out of these reports that are issued by the United States Department of Agriculture or in some cases other agricultural ministries or departments in other countries around the world. I just want to highlight a few of the things in some of the key reports that we follow here in the Midwest with respect to the grain and livestock markets and maybe try to help you think about why they're important or how they actually end up influencing the market. So as we get started, maybe first off, we're going to spend just a little bit of time looking at some things that you probably remember back from Econ 201 there when you took that at South Dakota State and learned about supply and demand curves. And of course, looking at this graph here on this slide, that's what a supply and demand curve looks like when you look at it in the textbook, an upward sloping supply curve, a downward sloping demand curve. So in other words, the higher price levels are, the more quantities people are willing to produce as farmers, for example, but the less consumers are willing to buy as price levels go up. And so there's a lot of theory, of course, behind that. I don't really want to spend some time talking about that because you can remember that maybe from your college class. But what I want to point out here is that in the real world, things aren't nearly that simple as to look at that supply and demand curve. In fact, as economists or as market participants, what we really have is a graph that looks something like this one. You have all these price quantity points on a graph, and somehow or another we try to trace out where that supply and demand curve is. Now, one of the things that economists do spend some time doing is trying to understand what that supply and demand curve looks like. Does it look like, for example, the ones that I've drawn through these intersections of all these price quantity dots here? They could be like this, they could be more up and down, or they could be even more vertical too. It depends on the elasticity of supply and elasticity of demand and all those sorts of things. But one of the reasons that I bring this up is because it really underscores the difficulty of trying to understand whether you're experiencing a shift in the supply or demand curve or a movement along one of those curves when you see quantities change or price levels change. And by that I mean, think about this, a supply curve shift, for example, to the purple S1 line here, or an increase in supply to the purple S2 line from that original green supply curve, is either a decrease or an increase in the supply schedule, or in other words, in the overall supply. We also have a movement along the original supply curve, which could be really considered no change in supply. It's a change in quantity supplied, and there's a key difference between those. The key thing to remember there when you're looking at a set of points that just look like this is we're trying to figure out whether we're moving along that supply curve, or conversely the demand curve, or whether we're looking at a shift in one of these two curves. It has everything to do with trying to predict where price levels are going by knowing whether you're looking at movements along those curves or shifts in those curves. The things that change supply are input prices, technology, returns to competing products, prices of joint products, and changes in the amount of risk. So you think about that, and production agriculture is an easy one to see a lot of these things. For example, farmers tend to increase the amount of production, corn and soybeans, for example, as they have more technology, as we've seen hybrid seed come about, as we've seen the triple stack varieties and all those other technologies that we use in corn and soybean production. It's essentially increased our yield per bushel, and that's ended up increasing supply. Input prices, however, tend to move the opposite with supply. When we're thinking about higher input prices, if it costs more to grow a crop, we're going to see a decrease in supply if you hold everything else constant. There's other things, of course, that influence changes in supply as well, including the return to competing products. For example, your supply of soybeans will go down if the profitability of growing corn increases. So they're related in those sorts of things as well. Price of joint products also has an impact. For example, picture the soybean meal market and the soybean oil market. Both are produced in fixed proportions from a bushel of soybeans. If the price of soybean meal suddenly skyrockets, you're going to have an increase in supply of soybean oil. Not necessarily an increase in the price of that, but an increase in supply because the joint production of the soybean meal is going to change and increase there. Changes in the amount of risk have a big impact, I think, on supply, and it's important to think about that as well too, because it's increased so much in agriculture as we've seen increased in capital requirements for production, both on the livestock side and on the crop side. The more risk and the more volatility we are, the less willing we are to supply at any given price. So one of the things that I want you to note here when I talk about changes of supply, and again, that's shifts in those supply curves, what you're not seeing there is a change in the price of the good itself. A change in the price of the good itself is really a movement along that supply curve. It's not a shift in the supply curve. And again, that's important because it gives us a gauge as far as whether price levels are increasing or decreasing. Now let's go back to that same slide again, and I've drawn in my theoretical supply and demand curves with all these empirical dots, all these empirical relationships that we see between prices and quantities. And now let's think about the demand curve. Demand curves can shift outwards, for example, as evidenced by this move from D to D1, the red line, or it can decrease, as you see to the downward left shift. Or you can also have a movement along that original demand curve. Again, not easy to trace out when you're just looking at a series of dots that look like this, but certainly it's important in terms of trying to forecast where price levels are going. Now, when you think about things that can change the price of a commodity in terms of changing the demand of for the commodity, these are the things that will tend to shift the demand curve, either outward to the right or inward to the left. Prices and availability of other commodities tends to be quite important for that. For example, picture a consumer that is in the grocery store and making a choice between purchasing pork or beef. If the price of pork is very high, they may buy less of that commodity but increase the demand for beef in that particular case. So the prices of other commodities tend to influence demand for a particular good. Consumer tastes and preferences are a big one, and we've seen that so much over the years in the protein market, especially in beef. For example, here a few years back when the high protein diets were very much trendy and found consumer preference, we saw big increases in the demand for products like beef and pork and eggs and less in products like flour and other wheat goods. So those things have a change in the impact on demand. Consumer income has a big impact as well on those shifts in demand. Basically, the more disposable income a consumer has, the more he or she is likely to pay for a particular product, and at any given quantity level, and so that tends to increase or decrease the demand for a product. Note here again that one of the things that's not listed on this slide in terms of things that change demand is the price of the good itself. Again, that's a movement along an existing demand curve, not one of the things that tend to shift the demand curve. Okay, so now let's come back to the original subject, having had that little quick review on supply and demand back from your college classes there. So one of the ways we try to figure out where these points are, these plots in this price quantity space, is the information that's provided in some of these government reports. Now there's a variety of industry reports out there too. I'm just concentrating on some government ones here because they tend to be some of the most widely used and read and well-respected ones out there. And so the information that we see in these reports mostly gives us information about quantity. In other words, are we looking at higher quantities or are we looking at lower quantities over this time, over a particular growing season, for example, or whatnot. So really what we're trying to do is get an idea of if we're looking at quantities that are maybe in this area or maybe ones that are farther out, bigger quantities or smaller quantities. With that information and historical relationships, we then go back to trying to plot out where these supply curves might be and where these demand curves might be. So that's where we're headed with this. Now, when we think about some of the government reports that we pay a lot of attention to if you're in the crop or livestock business, here in South Dakota or other Midwest states, we tend to think about some of these reports. The cattle inventory report, that comes out in January and July. The Cattle on Feed report is another USDA report. That comes out monthly, typically on Friday afternoons at about 2 o'clock Central Time. The Hogs and Pigs report is a quarterly report that is released again by USDA, usually on Friday afternoons. On the grain side, one of the key ones that the market focuses on, both here in the United States and around the world, is the World Agricultural Supply and Demand Estimates. We often call that the WASDE report, and you'll note that I often write about that on the iGrow website, the results of those WASDE estimates that come out, and those reports are released at about 7:30 in the morning Central Time, typically towards the beginning of the month, usually roughly between about the 5th and the 12th of the month or so. The quarterly grain stocks report's another report that is released that provides information about how many bushels of corn and soybeans and wheat and other commodities are being held in both commercial and non-commercial or farmer storage. So it gives us a little bit of an estimate of what kind of supply is still available out there for buyers. One of the reports that we focus on a lot in February and March and April is the Prospective Plantings report. That report comes out on March 31st each year and gives us the first survey-based estimate from USDA of what farmers are intending to grow for the year. So oftentimes, for example, in 2012, you're hearing a lot of talk about 94 million acres of corn is forecasted. The first survey-based estimate we're going to see will be on March 31st this year in 2012 and get an idea of what farmers are planning to actually plant for 2012 production. Granted, these things all tend to change, and that's one of the things I want to talk about with respect to these reports. The information changes and is reforecasted and updated on a pretty timely basis in many of these cases. Crop progress and condition is one of those. Crop progress and condition report is actually a weekly set of information put together by USDA that updates market participants on what the progress is of growing crops, corn, wheat, soybeans, and a variety of others, as well as their condition, how many of them are rated fair or good or excellent, and so on. So if you're interested in getting a hold of these reports or when they're released, that URL there at the bottom of the slide is one to go to there on the National Agricultural Statistics Service. That's where USDA has their calendar of when those reports are going to be released. And like I said, some of these are weekly, some are monthly, some are quarterly, and some of them are actually annual. Now, one of the things in terms of interpreting what these reports mean is trying to figure out what it is that's actually influencing the market and the timing associated with that. The report's release is well anticipated usually by the market. Typically what you see is industry and academic and other market analysts have expectations of what that report is end up going to say about either supply or demand information. Oftentimes this information is put together by these market analysts and is pretty widely distributed through the national ag media and other newswire services. This information is used by traders really around the world to bid prices higher and lower in the futures market. And by doing so, the pre-release estimates are, so to speak, bid into the market price of the particular commodities. So, for example, if all the analysts and all the traders out there are expecting a lower supply, they're going to start bidding prices up even before the market report comes out from USDA. Or if they expect higher demand, they're going to do the same thing. They're going to start bidding up prices in anticipation of a bullish report. Conversely, if supply is expected to be higher in an upcoming report or demand to be lower, you're going to see these traders start selling off the market, in other words, driving price levels lower in anticipation of a bearish report. Essentially, the largest profits from a trading perspective are going to come to those that initiate that position first. And so the culmination of all this happening on a very large scale basis is to really bid in the pre-release expectations going into those reports. Now you say, well, how can you come up with these kind of pre-release expectations? Well, it depends on what specific commodity you're talking and what specific items you're trying to forecast. But for example, if you're thinking about in the cattle on feed report, for example, the marketing's number, well, you can get a forecast of that what that monthly marketing figure is going to look like by going back and looking at the previous month's actual slaughter data that's already been released by USDA. So there's a number of different ways we can do that with all the data that's available out there, as well as our own information about the markets as we see them trade. So when we think about market reactions to reports, we again come back to this idea that it's relative to where market prices were bid into to the market before the report actually came out, what those pre-release expectations were. And we gauge a report by being bullish or bearish relative to what those pre-release expectations were, not necessarily whether supply was in and of itself higher or lower, or whether demand was higher or lower in and of itself, but how they compared to the pre-release expectations. A report can be bullish, for example, if the reported supply ends up being higher, even if it's higher than what had been previously forecasted, as long as that supply forecast turns out to be lower than what the traders were expecting going into that report. So even with a higher supply being reported, it can still be bullish if it's measured against expectations that are actually going to be higher than where that original supply forecast was. Similarly, on a report that's bearish, again, it's measured relative to those pre-release expectations. If the reported supply comes in more than expected, that's going to be fairly bearish, even if it's a lower supply than what had been forecasted, for example, in the previous month's report. Let's take a look at some examples. That actually makes things, I think, a little bit more clear. And to start off with, I'm just going to show you the cattle on feed report, and this happens to be from the February 2012 cattle on feed report. And you see here, for example, the placements number during January, the fed cattle marketings during January, other disappearance for January, and then the February 1st on feed total here. And again, if you want to take a look at any of the cattle on feed reports, the URL there at the bottom of the screen can help you get directly to that particular report. One of the things here that's important to note is in terms of what these numbers actually mean. Placements, of course, are cattle going into feed yards. And so the larger that number tends to be, the more bearish that information tends to be to market prices, because it essentially signals that there's more cattle going to be marketed, usually between about 80 days on out to about 200 days from now. If placements are lower, that tends to be fairly bullish information because there's going to be less supply coming into the market. Marketings are actually just the opposite of that. When marketings are higher, that tends to be bullish to market prices, and the reason for that is because if cattle have been marketed in the previous month, that means there's fewer cattle available in feed yards than there were previously, and in other words, they've been slaughtered already and have already entered into the meat chain, so the available supply of cattle has shrunk, so that's actually bullish information. The cattle on feed number is really that stock number at the first of the month, and is negatively related to their inventory number. So when on feed numbers go up, that tends to be fairly bearish to the market price. Conversely, when on feed numbers drop, it tends to be bullish towards market prices. So let's take a look then comparing this to pre-release expectations. Remember, I said that's what really was important here. In January, for example, placements of cattle were actually about 1.847 million head of cattle. That's a decline of nearly 3% compared to previous year. We often compared relative to year ago numbers to get a feel for how things are changing across time, and it's always important to compare month to month because there are seasonal trends in just about all data. Now, it's hard to look at that and say, well, if it's bearish or bullish without coming back and looking at the pre-release expectations that I was talking about. In and of itself, the fact that placements were about 3% lower is fairly bullish to the market prices. But we come over here and look at, well, on average, producers were already expecting about a 1.2% decline in placements in January of 2012. The range of expectations between all the analysts surveyed included almost a 6% drop up to almost a 1.5% increase in placements. Now, the fact that this number came in just a little bit lower than expectations, in other words, 97.3% of a year ago instead of almost 99% of a year ago, relatively friendly to the market. In other words, the number of cattle being placed in feed yards was a little bit less than expected, a little bit less supply than expected, and as a result, that tends to be a little bit on the bullish side when looking at that particular number. But then when you come over here to the marketings number in January, taking a look at that, about 1.8 million head in January, that was about 2.4% higher than a year ago number. The trade was only looking for about even with year ago levels, but varied fairly widely, again, between about 94 up to about 104% of year-ago numbers. So the trade ended up with about a 2% increase in January marketings. That tends to be just a little bit on the bullish side there as well. So both the placements number and the marketing number just a little bit on the bullish side there, because placements were lower and marketings were higher, both of them saying a few less cattle in feed yards. And so when you look at February 1st cattle on feed numbers, they ended up being just slightly lower than what traders were expecting going into that report, about 2% higher relative to a year ago compared to 2.5%. All in all, this tends to be a fairly neutral to slightly bearish type of report for all those reasons, trying to look at each of those individually. Now, in this case, one of the things to note here is that we have more cattle on feed on February 1st. That sounds like that should be fairly bearish to the market, but market already had been bid was actually already anticipating that and was probably bid down just a little bit because of that going into the report. So the overall reaction following the report's release was fairly bullish. Now, I just wanted to very quickly highlight a couple of things that sometimes I talk about on the igrow.org website relative to the cattle on feed report. If you keep track of this data on a monthly basis, it can provide you a lot of information, and there's other information in there that's relatively useful as well. For example, the timing of the placements figure that we were just looking at on the previous slide gives us information about when cattle are going to be marketed. For example, there is information provided in the report how many of the placements were weighing less than 600 pounds, how many of them were weighing about 600 to 700 pounds, how many of them were weighing 800 to 900 pounds, or 700 to 800 pounds, excuse me, and then how many of them weighed more than 800 pounds. That information is helpful because it gives us a timing information on timing when a big surge of cattle could end up coming to market. Now, typically we don't tend to see large walls of cattle coming and big holes in marketings, although it's talked about a lot. But those 800 pounders are going to be marketed much earlier than those less than 600 pounders that are probably going to take 240 days or more on feed. So it gives us some information on timing, the impact of future marketings. And because of that information, we can estimate what cattle are being placed at in terms of their average weight going into feed yards. Gives us some information about what weights they'll be coming off of feed, because lighter weight placements tend to finish at lighter weights. And again, gives us information about when cattle will be marketed later too. Another statistics that can be calculated, it's not actually directly in the cattle on feed report, but looking at them across months can give you information about how many cattle have been on feed for more than 120 days. Often you hear people like me talk about this being the front end supply of cattle. If cattle have been on feed for more than 120 days, they're pretty apt to be marketed coming up in the next probably month or so. And because of that, that gives us information about when marketings will be occurring there as well too. So we watch that, and as the cattle on feed more than 120-day inventory grows, that tends to suggest that packers might be in a better negotiating position with cattle feeders. We also can use information in these monthly reports to calculate marketings as a percentage of inventory. And the reason that information is useful is it gives us an idea how often cattle feed yards are being turned over, or how aggressively they're marketing cattle relative to their total on feed number. The higher that percentage tends to go, the more beneficial it is for cattle feeders to be able to maintain good leverage in terms of their negotiation and being able to try to work prices higher. Now let's take a look at the WASDE report. I mentioned that was another popular monthly one and tends to be very important both to grain and livestock producers, particularly grain producers, because it's very much watched in terms of both the grain and oilseed market, but livestock products are also reported in there as well too. Again, that web address is down there at the bottom, so if you want to take a look at those reports, go directly to that website. The WASDE report itself provides both domestic information within the United States as well as world information. I'm just going to focus on some of the domestic information here in terms of the balance sheets. Now, balance sheets are essentially all the supply added up plus all the demand added up, and the difference between those two are ending stocks. And USDA reports this for the grain and oilseeds markets that we often follow for about 3 marketing years. The current and the previous years are revised monthly, and so there's always an estimated year, a forecasted year, and then the year that was essentially. Here's the corn balance sheet from the January 2012 WASDE report, and you can see what I mean by the 3 marketing years. The first marketing year, or the first column that you're seeing here, is the 2009-2010 marketing year. The 2009-2010 marketing year for corn actually starts on September 1st and runs through August 31st. That's the corn marketing year. Same for soybeans, and wheat marketing year is July 1 through August 30th. But when you're looking at these marketing years, then the 2009-2010 numbers aren't being revised anymore, but the 2010-2011 marketing year that essentially ended August 31st, 2011, has ended, but those numbers are still being revised based on actual use numbers that are still being calculated. The last 2 columns that you see are 2 different projections for the 2011-2012 marketing year that ends on August 31st, 2012. USDA makes these estimates every month, and you see the December estimates there that were projected, and the January projections as well. USDA did the same thing in February and March and April and so on until it starts forecasting its new marketing year, the 2012-13 marketing year, in May, in its May release. Now, just taking a look then at some of the numbers in these reports, you see here in the top part highlighted is mostly supply information, the number of acres planted and the number of acres harvested. Typically, we have what we call abandonment of about 9% or so in the United States. In other words, about 9% of corn that's planted isn't harvested for grain, either because it's cut for silage or abandoned due to drought or flooding or a variety of other problems. So planted acreage, along with forecasted yield information, gives us information about how many bushels are being produced. Essentially multiplying the 2 gives us our production number, and that's the number you see down there, for example, in the farthest right column. About 12.358 billion bushels of corn was the forecast production for the 2011-2012 marketing year. Also on the supply side, we see the amount of corn being imported into the United States. Typically, that's a pretty small number, about 15 million bushels in the 2011-12 marketing year. We also see what's called beginning stocks. Beginning stocks are essentially the corn that was left over from the previous year's supply. Note here that it's about 1.1 billion bushels. A fairly small number, but it's been smaller than that before too, but it tends to be a little bit on the smaller side. Notice there, for example, then that that the ending stocks number that we'll get here to in a minute, but the ending stocks number from the 2010-11 marketing year is what constitutes the beginning stocks for the next marketing year. So that's the supply side of the demand balance sheet. Let's take a look at the demand side of this balance sheet, and you see, for example, the amount of bushels that are forecast to be used for feed use. That's about 4.6 billion bushels. You see the amount that's being used for industrial uses. Industrial uses include ethanol, which accounts for almost 5 billion bushels of corn. Just recently, in the last marketing year or so, we've seen the amount of ethanol used, corn used for ethanol, surpass the amount being used for feed, because our livestock numbers, both on the cattle, hog, and poultry side, have all been declining. So corn use has been declining there. The other major major demand source is exports, and that accounts for just over 1.6 billion bushels of corn in this 2011-12 marketing year. So adding up all the supply information here, you've got about 13.5 billion bushels of corn. Demand for corn projected at about 12.65 billion bushels. That leaves an ending stocks figure of about 846 million bushels of corn. That's the number I was kind of trying to get to here, because that is the supply number, so to speak, that we look at and try to forecast then where the prices end up going from there. And the reason we can do that is because we look at the stocks-to-use ratio and its relationship to price. When I talk about a stocks-to-use ratio, I'm essentially talking about that ending stocks number, that 846 million bushels, divided by total use. In this case, about 12.65 billion bushels. That gives you a stocks-to-use ratio of about 6.7%. Doing the same calculation in the previous marketing years, you can see that the stocks-to-use ratio has been falling over the last 2-3 years. The reason that's important is because it's a relative measure of supply and demand. It gives us an idea of how tight the marketing situation is relative to corn. the tighter that number is, or the smaller that number, the higher corn prices tend to be. In fact, if I go back and show you that going all the way back to 1973 on this graph, you can see that there's an inverse relationship between farm prices, which you're seeing on the red lines, and the stocks-to-use ratio. Typically, the higher that stocks-to-use ratio is, it means that there is more supply out there relative to the demand available, and consequently prices fall. In years like we've seen most recently, there tends to be very little extra supply out there relative to the demand for corn, and as a result, prices tend to get higher and higher. So that information helps us get a forecast on where corn prices are going to look to go. Again, very important to compare the actual numbers that are reported in these WASDE reports to pre-release expectations. Going back and looking, for example, at the January report, USDA reported actual yields coming in at about 147 bushels per acre. Now that's relatively low compared to a trendline yield forecast, but it was slightly higher than what the trade was expecting. The trade was expecting about 146. The actual USDA number came in at 147, so even though that's a low yield, which should have drove prices higher, that's actually kind of bearish to the market because it's already bid in a 146 yield. USDA said 147 in that report. So as a result, production tended to be up closer to about 12.3 billion bushels instead of about 12.2. So that was a little bit on the bearish side. Ending stocks ended up coming in well above expectations. So in other words, more supply out there than what the trade was expecting. Trade was looking for about 752 million bushels. Actually came in at about 846, so higher than expected there. Overall, this report looks to be a little bit on the bearish side. Just a couple other notes here to wrap up on the WASDE report. The marketing year is the one that's projected going out 1 year in advance. Corn and soybean projections begin in May of the preceding year. So for example, the 2012-2013 marketing year projections for corn and soybeans will actually happen on May of 2012. And will continue on that cycle for 1 year until it becomes the estimated column in May of 2013. The marketing year, like I said, is estimated for 1 year, and then it becomes the year that was, so to speak, in that farthest left column in the report. A couple other key months to watch for in the report, in the WASDE report. August is the first month that you see survey-based estimates for yields for corn and soybeans. So basically from about May through July, USDA is forecasting yields based on trendline forecasts, which are basically a statistical estimation based on previous years, and they make some minor adjustments for what weather conditions are and growing conditions across the United States. But that's the first time we see actual objective yield-based surveys coming out of fields. January is also the final time that you see the yield estimated for the corn and soybean crop as well. So January of the following year after we harvest our grain, that's the last time that USDA estimates production numbers. So the January report is very highly anticipated to look at what that final yield estimate is, again, a supply number. So there's a lot of information in all these government reports, and that's maybe just a quick snapshot of some of the important things at least to be watching for. Some more information on the USDA Cattle on Feed report is available on Extension Circular 850 from University of Nebraska and 851 on the USDA Quarterly Hogs and Pigs report. Those are reports that I wrote there, and I invite you to take a look at those as well. And of course, join igrow.org for up-to-date information on some of the WASDE reports, crop progress and condition reports, and cattle on feed reports as they're released.